Successful investing does not necessitate superhuman intelligence, insider information, or even luck. Instead, a solid intellectual framework for making decisions is required, along with the ability to keep emotions at bay. In The Intelligent Investor, Benjamin Graham presents such a framework, along with logic, to help you keep your emotions in check. He may be investing, and straw has been one of the most successful investments in the last 100 years. The impressive records of not only Graham but also many of his disciples are impossible to ignore. Warren Buffett is the brightest shining star among these. Warren Buffett describes this book as by far the best book on investing ever written. In this video, I will present the book's top takeaways, in my opinion. Meet Mr. Market. Assume you own a portion of a business for which you pay $1,000 per day. Mr. Market, a bipolar individual, comes to your house with an opinion on how much your share of the business is worth. In addition, he offers to buy your share or sell you another. On that premise, history has shown that Mr. Market's estimate of how much your share of the company is worth can be nonsense. For example, in March 2000, he estimated the value of your share to be $2,600. Only 1 year later, in March 2001, he thought it was worth $500. Despite the fact that the company's income increased by 50% and profit increased by 20% during the same period. Should you let this guy decide how much a $1,000 investment in that company is worth? Of course, one of Graham's core principles is that a stock is more than just a ticker symbol and a price tag, it's an ownership stake in a company. Because Mr. Market isn't always rational, the underlying value of the company may differ from the price he's willing to pay for it. In fact, it is frequently overpriced or underpriced, as Mr. Market is prone to becoming overly optimistic or, conversely, overly pessimistic. Graham advises you to invest only if you are confident that you will be able to hold the stock in the future despite the fluctuating prices that Mr. Market presents you with. However, for the investor who can keep his cool, Mr. Market offers a great opportunity to make money because he does not compel you to make a deal with him. He simply gives you the opportunity to do so. When the office prices are ridiculously high, you should be happy to sell to him. Similarly, you should be happy to buy from him when he offers you a good deal. We must remember that when Graham wrote this book, people were far less bombarded with news forecasts, stock quotes, and so on than we are today. Mr. Market arrived once a day today, along with the morning newspaper. He wants to do business with us every time we open our phones, which is more than 100 times per day if you're anything like me. Just because Mr. Market visits you more frequently does not imply that you must trade with him more frequently than people did in the 1970s. If he does not present you with an offer that meets your criteria, ignore him and go about your business. Takeaway number 2. Investing as a defensive investor. According to Graham, there are two types of investors: defensive or passive investors and enterprising or active investors. Most people are better suited to the defensive strategy because they have limited time to devote to investing. The defensive investor should build a portfolio that includes a mix of bonds and stocks, such as 50% stocks and 50% bonds. It is important to note that how much you should allocate to each asset category is dependent on your current situation and the current difference in the average yield of stocks versus bonds. You should restore this allocation once or twice a year. So, if stocks suddenly account for 60% of the portfolio while bonds account for 40%, sell stocks and buy bonds until 50-50 is restored, then invest a fixed amount of capital at regular intervals. For example, immediately after receiving your salary. This is known as dollar cost averaging, and it allows for a reasonable average price of stocks and bonds. Most importantly, it will ensure that you do not concentrate and that you buy at the wrong time for the stock component of your portfolio. Defensive investors should aim for the following 81 diversification in the companies in which they invest, 10 to 30 companies. Also, make certain that you are not overly exposed to a single industry in which the companies should be registered, which Graham defined as having annual sales of more than $100 million. After inflation, this equates to about $2,700 million in today's dollars. Look for companies with conservative financing. A company with a current ratio of at least 200% qualifies. This means that it has at least twice as many current assets as current liabilities. For at least the last 20 years, shareholders should have received 4 dividends. 5 have had no earnings deficits in the last 10 years, and 6 have had at least 33% earnings growth in the last 10 years. This equates to a conservative annual growth rate of more than 2.9%. 7. Avoid overpaying for assets. The stock price should not be more than 1.5 times its net asset value. Subtracting the company's liabilities from its assets yields the net asset value. 8. Also do not overpay for earnings. When using the previous year's earnings, the pay ratio should not be greater than 15. Today, an alternative is to invest in an index fund, which by definition will have returns similar to the market average. If you are content with an average return from your investments, you only need the first two takeaways. However, if you crave more, you will also need to consider takeaway number 3, how to invest as an enterprising investor. Because it is so easy for the defensive investor to get the market's average return, beating the market appears to be a simple matter. To be an enterprising investor, you simply devote a little more time to investing than these average investors do, and beating the market is much more difficult. That social logic suggests that learning requires patience, discipline, and eagerness. And many times, both professionals and private investors are unsuitable for this. It's easier than one might think to fall victim to Mr. Market's price quotations. Listen to these two statements made by the chief investment strategist of two large mutual funds in the early 2000s, at the height of the dot-com bubble. There is a new world order. We see people dismissing all of the right companies with all of the right people and visions because their stock price is too high. That is the most serious error an investor can make. The stock market is riskier today than it was 2 years ago simply because prices are higher. The answer is no, but the answer is, of course, yes. Yes, yes. Both statements proved costly to the investors who placed their money in these funds. Because the profits that companies can earn are finite, the price that an intelligent investor will pay for these companies must also be finite. Price is an extremely important factor for the enterprising investor, as the market tends to overvalue when they are rapidly growing or glamorous. For some reason, it tends to undervalue those with inadequate development. As a result, the wise investor should try to avoid so-called growth stocks as much as possible. Why? Simply because investment decisions are based on future earnings, and future earnings are less reliable than current valuations. If, on the other hand, you can find a company that is worth less than its net working capital, all fixed assets, such as buildings, machinery, goodwill, and so on, are effectively free. Total liabilities are subtracted from current assets to calculate net working capital. During Graham's investment career, such companies proved to be extremely profitable. Unfortunately, they are rare today, except during difficult bear markets. Fortunately, Graham suggests another method for the enterprising investor to find investments. These criteria are similar to those that defensive investors should use, but the constraints are looser, allowing enterprising investors to consider more companies. This is not to say that there are no constraints on company size. Diversification is also recommended, but the number of companies held isn't set in stone for the active investor analyzing a company. The astute investor should also read the company's annual financial reports. Graham has written an entire book on the subject of financial statement interpretation. So we'll talk about it further another time. Takeaway number 4 emphasizes the importance of a safety margin. There is one risk that no amount of careful thought can truly eliminate: the risk of being wrong. You can, however, reduce the risk of doing so. You must insist on a margin of safety for every investment you make. As previously stated, when the price is at its highest, the price and value of the company are not always the same. It is worth 2/3 of its calculated value. The investor has discovered a company with a sufficient margin of safety. You wouldn't build a sinking ship if 31 Vikings paid for it. If you know it will be used to transport 30 of them on a regular basis, you should not invest in the stock that you believe is worth, say, $31. If it is currently priced at $30, your calculation may be incorrect. In the first case, a horde of angry and wet Vikings may pursue you in the second. You could push back your financial independence by a couple of years. I'm not sure which situation I consider to be worse. Use safety margins. A formula in the book can give you an idea of the company's value and thus whether it can be purchased with a margin of safety equal to current normal earnings times 8.5 plus 2 times expected annual growth rate. The growth rate should be equal to the earnings expected annual growth rate over the next 7 to 10 years. Here is how much the 3 largest companies in the S&P 500 are worth according to the formula in September 2018. Note that we can use the formula backwards to trace how much these companies must grow in the next 7 to 10 years for today's stock prices to be rational. There is a significant disparity here. According to its stock price, Amazon is expected to grow at a rate of 74% per year, while Apple is expected to grow at a 5.8% annual rate. Do you believe this is a reasonable takeaway? According to academic theory, risk and reward are not always correlated. An investor's expected rate of return must be proportional to the level of risk he is willing to accept. Risk is then defined as the volatility of the investment's returns, or how far it has deviated from its expected value in the past. Graham disagrees with this assertion. Instead, he contends that the price and value of assets are frequently disconnected. As a result, the return that an investor can expect is a function of how much time and effort he puts into finding bargain assets. The defensive or passive investor receives the lowest return, while the enterprising investor who exercises maximum intelligence and skill receives the highest. Consider the following. It's 4 a.m. after a night of drinking in the streets of Moscow with your friends. You decide that it's too early to call it a night and end up in the more obscure parts of town. A man approaches you in a particularly ambiguous bar and asks if you want to play a game. Of course, games are fun, your bravest and least sober companion responds. The man places a revolver in front of you, loaded with a single bullet. If you dare to play Russian roulette, I'll give you $10,000. Your inebriated friend reaches for the gun, but you stop him. I believe we will pass on this one. You inform the man politely, I thought so. He responds, what about $100,000 for taking 2 shots? This story now represents the academic way of requesting a greater potential reward for taking a greater risk. The first offer was for $10,000 with a 16.7% chance of blowing your brains out. In the second proposal, because the risk of putting a hole through your head has increased to 33.3%, the reward is $100,000. Doesn't that seem logical? But does stock market investing have to be this way? Remember that price and value are not synonymous. If you buy a company for 60 cents on the dollar, you have a high potential reward and a low risk. Furthermore, if you can find another company that you can buy at 40 cents on the dollar, you have found an even better potential reward combined with an even lower risk. How could anyone in their right mind argue that buying a dollar at 40 cents is riskier than buying a dollar at 60 cents simply because the potential reward is greater? A quick recap of the 5 key points. To begin with, the market has a tendency to be both overly optimistic and overly pessimistic at times. Don't let this affect your perception of the true value of your assets. Instead, view it as a business opportunity in which you get to deal with someone who has no idea what he's doing. Second, the defensive investor should choose a diversified portfolio of stocks and bonds, or the stock category should be comprised primarily of low-cost issues. Third, the astute investor should seek out stocks with lower price tendencies. He might have found his El Dorado if he can find a company that is trading below its net working capital. The fourth and final takeaway is that an intelligent investor should insist on a margin of safety when purchasing an asset. Is that risk and reward are not always correlated? What are your thoughts on Graham's advice? Are they still as relevant today as they were in the 1970s? Comment below to share your thoughts with other viewers. As always, please leave a comment if you want me to summarize a specific book on investing, personal finance for money management. And please let me know if any of the book's takeaways pique your interest and you'd like me to elaborate. Don't be embarrassed. You may also make a comment on that. Thank you for watching, and have a great day.